Hello, everyone. Welcome to the market update for Tuesday, March the 14th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to jerry@traderspro.com. Make sure you send it to that email address. If you send it to support, then it can get lost in the system there. I got an email the other day that by the time I got it, it had been 3 or 4 days. And so make sure you send it directly to jerry@traderspro.com, and I'll be happy to answer that for you. Also, if there's any audio issues, make sure you let me know. Any clicking on the audio or any obnoxious sound, let me know. I can usually dial back in and get rid of it. I just can't usually hear it on my end, so I rely on you guys to let me know. I apologize for a little bit of the mix-up last week. The week before I had talked about going on vacation. What happened? My mom passed away a couple of weeks ago, and obviously, if you've lost a parent, you know that not a fun time, and so I want to just kind of get away. Usually my vacations are working vacations, so I set it up pretty quickly. I didn't. It wasn't something I had planned out for weeks. In fact, I basically set it up right around my mom's funeral. So it was quick. I was able to get the notice out in the class that I was going to be gone, but there was a little bit of a mix-up there in communication. Some people missed the class. Hopefully, you were able to view the recording though, and just remember that these are all recorded. You go under the Learning Center and access the recordings. So if you have to miss a day or something like that, you can catch up there. So anyway, I wanted to apologize for that. But it's also kind of funny what I talked about last week. Every time I go on a vacation, it seems like the markets start taking off or moving. We've been kind of in a stagnant condition, and it's happened too many times now where it just doesn't feel like a coincidence anymore. It feels like anytime I go on a trip, the markets become more active. The markets won't allow me to get away from everything and enjoy time off. So, but anyway, all right, let's get started. There's a lot to talk about. Obviously, there's been a big focus on the banks over the last week or so. If you remember back a couple weeks ago, there was, in fact, I'm going to go right to the chart here. We're going to come back to the direction alerts because I want to start talking about the charts here first. But if you remember back in this area right here, we started to rally up a little bit, but it just wasn't making any sense. We rallied up a little bit, and then the VIX, we pull up the VIX chart, the VIX was moving down below 18. It was moving back below 18 right here. And at the time I said, if the market tries to, it could possibly rally from here. But the problem is that with the VIX down that low, I just couldn't see it rallying that far. And the danger I was seeing was that it was setting up for a bigger move down. And at the time, if you remember, you can go back and review some of these past recordings. I can never remember which one I talked about it, but you can go back to around these dates right here because it was right around that week where I talked about it. Then I said, what you wait for at that moment is some sort of a trigger. People need a reason to sell. They're not just going to go sell for the sake of selling because if markets keep going up, that's how people lose their jobs, is if they sold and they didn't need to sell. So they're looking for a reason to sell. And I said, very often when the market's getting this condition, you just start to look for a trigger. What's going to be the trigger for the selling? Well, sure enough, this was the trigger, and there's no doubt about it. It's a serious thing that's going on right now. If you're listening to financial news, people are trying to downplay it, and I get that. They're trying to keep people from panicking and pulling all their money out of banks because that would just collapse everything. It's amazing how how fragile this financial system is set up, where when it starts to unravel, you saw it. 3 banks in 3 days went under. When it starts to unravel, it can unravel very, very quickly, and it's just like the game of musical chairs. Nobody wants to wait until the music stops and find out they don't have a chair. They're gonna grab. They're gonna take their money out of the bank and not worry about anything collapsing. They want to make sure they're the first ones to get the money out before it collapses, and so it just it spirals out of control. But it's a good lesson in human nature and understanding human nature and how human nature operates within the markets. Every participant in the market is going to look out for their own self-interest first, and that's what can get some of these systems into trouble when everyone kind of dives in at the same time. Now, having said that, what's going on today is a lot of people are saying, don't worry about it, everything's going to be fine. In fact, there's a lot of people coming on TV saying this is a good buying opportunity. You should be jumping in and buying the banks and things like that. And be careful when you're. This is definitely a time where you don't want to be listening to anybody on CNBC or Fox Business or anything like that, because remember, what is the big driving force in the markets? It's our own self-interest, right? Well, there's a lot of these people that have been, especially some of the ones that have been bulls for the last several months, that they're going to get hammered if the market makes another big drop like it did over the last few days. And so in order for them to get out of their stock positions or to lighten up or whatever, they need the markets to rally or to stay up instead of dropping dramatically. If they drop dramatically, they're not going to be able to sell those positions fast enough, or they're going to exacerbate the selling by trying to get out of their large positions. So they're trying to get you to come in and buy to help them get out of their positions, or to prop their positions up in some way, or to prop the market up in some way. So this is absolutely the wrong time to be listening to talking heads on TV, particularly talking heads that are trading in the markets or they're running funds and things like that. Because I can promise you their focus right now is not on helping you and helping you get in at the right time. It is making sure that they don't lose too much money, or I'm telling you, if you look behind the scenes of Wall Street, it is ugly. There are sharks. There are just some really, really bad people that often participate in the markets. I'm not saying everyone that participates in the markets is a bad person, but it really often, especially in New York and on Wall Street, there's an ugly side of this, that people will do anything to step on other people. And it's been that way forever. It's been that way since the beginning of time. I mean, Roman Empire, same thing. You go through any sort of period. And that's why we talk about human nature. These things repeat themselves. We tend to do the same things over and over. But be careful that you're not listening to someone and saying, "I'm going to run in and jump in and get in right here." Pretty dangerous, especially with some of these banks. Let me pull up, before I get into the charts here, let me pull up a couple of the banks that have been in the news. First of all, the Silicon Valley, which is no longer, I might not even pull up because it's no longer trading. It was halted. And I think that's Silicon Valley Bank. Did I get the right one there? Anyway, what can happen is your trade, what's going on right now with these banks is they're protecting the people that have accounts in those banks. And so if you've got stock in these banks and they go under, your stock is worthless. So keep that in mind. if you're looking at these as a buying opportunity, it could disappear. And let me show you what's really kind of going on today, because everyone's talking about how these banks are rebounding. Let's take a look at First Republic. This has been in the news a lot today. This is what, again, gets back to the importance of being able to read price action, and why I focus so much on it in these updates. Everyone's talking about how strong these regional banks have rebounded today, and they have. But look at the price action of First Republic here. It opened up here right at the beginning of the day, and since then it's steadily been moving lower. It's still higher than where it closed the day before, but it's moving in the wrong direction. And what a day like this is, after this type of drop, where it dropped more than, look at that, it dropped 75% of its value. It was a $100 stock. 3 days later, it's a $25 stock or whatever. What's happening today is a short covering rally. Remember, I just got done saying, if you buy these shares and the company goes under, you lose that money. Well, if you're short and you don't take profits on those short positions, meaning buying back those shares and getting them back to your broker, you don't get to participate in that either. And so that's exactly what's going on right here. The majority of that buying is these short people have made a ton of money shorting the stock on this move down, that are getting out and covering those positions. What we're not getting is a lot of people, and that's why you're not seeing it go higher from the open, is you're not getting a lot of new buyers coming in for that very reason. It could survive, and if it survives and goes back to $100, it could be one of the trades of a lifetime for you, but it could also disappear and you lose everything. And a lot of these banks are in that position. And what's scary about First Republic today is that it's been halted several times today, meaning the exchanges are shutting it down where you can't buy or sell it, halting the trading on it. Then it opens back up again. And that happens when there's a lot of volatility, or a big imbalance between buy and sell orders that could collapse the stock from a trading standpoint. And so just be really careful. In fact, if you do want to get involved with, if you do think that these banks are going to survive, or at least the regional banks are going to survive, you're better off right now trading something like the KRE, where you're trading the ETF. But keep in mind too, though, the ETF isn't completely safe either. Although it spreads the risk out over several different banks, it has to buy and sell shares to run as an ETF. And so, some of these larger regional banks, which is what's getting hit right now, some of these larger regional banks could get still seriously damaged even in the ETF as well. So it's not a completely safe way to trade that sector. The smart thing to do is just let the dust settle. Even if these banks stabilize, they're not going to go right back to these levels right away. The way I describe something like this, when you get a big drop like this, it's kind of like a boxer. If you think of a boxing match, and somebody and one of the boxers gets clocked, and he goes to the ground and he's seeing stars. He doesn't know where he's at. You can tell he's got his bell rung. He doesn't just jump back up and say, "I'm fine, let's keep fighting." He gets back up slowly. If he can beat the 10 count, his head's kind of spinning a little bit. And even when he starts boxing again, he's trying to protect himself. And that's why the other boxer then really attacks at that point, because he's not going to he needs a little bit of time to get his senses back. Well, that's how I view these big moves down like this. When a stock gets slammed, it's not going to come rocketing right back up again. It's always possible it could do that, but the probability is it's going to base stabilize a little bit, probably move sideways and choppy for a long period of time before working its way back up. But these things, it's important to realize these things don't just get solved in one weekend. what really started to come back to me, having traded for a long period of time now, was the financial collapse of 2008. Now, I'm not saying this is going to be the same thing as 2008. There were a lot of other factors going on and different circumstances and things like that. But what I remember was we're seeing the exact same thing happen. When Bear Stearns went under in March of 2008, everyone said it's an isolated case. It's not that big of a deal. The regulators came in. They took over the bank, took control of it, and that was it. All these other banks are strong. They're not in any trouble. This was an isolated case. We're hearing the same thing now, and that's what scares me, is that I don't believe what I'm hearing because of what happened back then. And what happened back then, it took a little bit of time. There's a few more months before Washington Mutual went under, and I can't remember the other one that went under. And then it was Lehman Brothers. And then right about the same time, Lehman Brothers and AIG. I think AIG was, if I remember right, was the too big to fail one that really shut everything down and just caused the big panic that broke out. Like I said, I don't anticipate this is going to play out the same way, but it's having been through it though, and also what I learned from it was don't listen to people on TV telling you that nothing's wrong and to jump back in. Watch the chart, pay attention to the price action, and you're going to be a lot better off than if you're buying just because some bozo on CNBC said this is the buying opportunity of a lifetime or something like that. That's how people get hurt. And if these stocks recover and start moving up in a strong uptrend, so be it. We can jump back into those or consider those later on, but I'd be staying away from those right now, at least for probably a couple weeks or so. Let this kind of see where this kind of goes. All right, now let's take a look at the S&P chart. When you can see what's happened today is we gapped up. It looked like things were recovering pretty nicely, and look what we slid all the way back down. Now, some of it has been attributed to that drone accident in the Black Sea, where the drone, the Russian fighter jet crashed into the drone or what have you, and the market started to sell off right around there. But again, that's not the reason why the markets are going down. The reason why the markets are going down is because of the mood. Remember, I talk about this all the time, market mood. When we go through these steps each week, we're trying to determine the market move. Is the market feeling bullish or is it feeling bearish? Right now, it's feeling bearish, which means that it's looking for reasons to sell. And it could be any headline now that appears negative is going to, cause the market to sell off and be that reason to sell, and that's just another reason to sell. But that's what people talk about. They'll say, well, the market was looking good today until that accident took place, and then it started to sell off. I remember back in the Iraq war, Afghanistan war, people would say the market's down because of the war in Iraq. Well, we had been in the war for how many months, and the market rallied it during parts of that war, and now it's down, and now it's down because of the war. And well, why was it up? Was it up because of the war 2 months ago? So these are not true reasons. It's just a reason when the market is in that certain mood, and that's why we pay more attention to the mood as opposed to the news, because that's going to we're going to be more likely on the right side of the probabilities in that case. Now, I have had a couple of people point out, well, Jerry, is this a bullish ABC pattern right here? Now, I think this is important to this is where you can look at a move like an ABC pattern, and that's why I always use the term possible ABC pattern. Could it be an ABC pattern? It could. There's a couple things that make me suspicious of that, and a lot of it goes back to, let me find a clean Let me go to my other chart here. I can move it over and I can draw. Sometimes it's easier just to draw out what I look for. Remember the trend characteristics I always talk about. Stocks will tend to alternate between impulsive and corrective moves. And, that's the stair step. And so when you're stair stepping down, what's a sign of a possible bottom? One of the things I look at is, do you get a back-to-back impulsive moves in the opposite direction? Do you get an impulsive move down followed by an impulsive move up? Then you look at the next correction out of that, and very often you'll get that ABC, and then you're alternating between impulsive corrective again. You're in an uptrend. When you reverse, not always, but when you reverse from an uptrend into a downtrend, very often you'll get an impulsive move up followed by an impulsive move down. And then you get corrective. You alternate between impulsive and corrective. Well, the problem here is that, first of all, we had this big run up on the S&P. No, let's look at the chart here. So 2-year chart. So we had the big run up. And a lot of people are calling that October the bottom, October low the bottom. Okay. The problem I've had with that is that if that's the bottom, this should have looked more impulsive. It should have looked like an impulsive move up and then corrected. That's not what we got here. What we got is a big corrective move. This looks like a bearish ABC pattern right here. So this looks like a potential bullish ABC pattern. Okay. But the problem is that it's too deep of a retracement. You tip, and again, these are I'm just going off of probabilities right now. Could it still end up being that way, and the market takes off from here? And yeah, but again, difference between possibility and probability. We want to try to stay on the side of probabilities as much as possible. And with this looking more corrective, and this having a deep retracement down here. Remember, when we moved below that 6 or 8 retracement level, I said, now the probabilities are shifting. It's becoming more likely we're going to go down than go up. And so the chances of that being a corrective, a bullish ABC pattern and going up is very small. It's still possible, but not very probable. On top of that, you can throw in a trend line right here, which we broke below the trend line. We broke below it, came back above it a little bit, and then came back below it in a big way down here. That tells you that if this was an uptrend, it got broken. Okay, so that's not working on your side from a bull standpoint. Now, what else could it be then? Well, one thing I talked about a while back, and I kind of updated it from time to time, is I personally feel like this whole move down was just wave A. And why do I think that wasn't the bottom in October? And again, I'm probably going to people are going to start making fun of me for bringing it up all the time, but we never got that panic sell-off, which we always get in a major correction. And I think this is considered a major market correction. And so, I'm viewing that as wave A. I think this is wave B right here, although, and wave B tends to be a bearish ABC pattern coming up right here. Now, if we do rally higher, it could be, I've talked about how, you get these kind of double corrections or whatever. Maybe we do rally up into this area here and wave B ends up here. I always leave room for the markets to make unusual moves, because it does. It tries to throw everyone off. If something looks obvious, the market will find a way to make it look less obvious. It just does that. You have to get used to that. But the way we're acting, even if we rally up from here, is more corrective. It looks more corrective. Now, part of why there's still a possibility we rally higher is the market is getting into an extreme oversold condition. I'll show you that here in a second from the data on TradersPro that's showing that we're getting a little oversold. But the bottom line is that I think there's another move down coming, which would be wave C, and it's probably going to be a pretty devastating move. And part of really what reinforces this to me is that the market just is not factoring in. Even today, the VIX is right back down. It got up to 30 yesterday, but it's back down to like 25, 26 or somewhere in that area there. I have to look at it here in a second. It is not, the market is not reflecting the conditions right now, how out of control this could get. Again, you try to keep a level head, not panic or be quick to panic, but there's also a feel like you should have some concern, and we're barely even showing any fear. We barely reached the fear area on the VIX yesterday, and so these things all add up to, for me at least personally, that we're setting up for something big. Now, it's impossible to really be able to perfectly time these moves, and a lot of times they can come out of nowhere, but it just has that feel. I've been through enough of these now where this just has that feel of we're probably going to see things get worse before they get better. And people always talk about how it's still fine and everything's okay when you're just starting the big decline, and then it shifts pretty quick. I also kept saying that what you're going to want to see to know that we're getting close to a bottom. Not only is that VIX spiking up over 40, but you're going to wake up one of these days and the Dow is going to be down 2,000 points or something really dramatic, where you're looking at that saying, I can't believe what's going on. And if you look on CNBC, people are scared. You get these traders on, they don't even want to show up on these shows because they're freaking out. And nobody is telling anyone to buy. That's when you know that you're getting pretty close to the bottom at that point. But anyway, what I think could be going on is this is a bearish ABC pattern, and that we're starting to move down. This is wave one, wave two, and I think we're in wave three. Even with this little attempted rally today, there's 5 waves within these waves as well. These smaller waves, there's smaller waves within the larger waves, and if you think about it, if I've got 5 waves down on a wave A, 1, 2, 3, 4, 5, and then you get 3 waves for wave B, that smaller ABC pattern. This is A, B. When you're starting the 5 waves down, what does wave 1, 2, and 3 start to look like? It starts to look like a possible bullish ABC pattern, right? That's wave 1, wave 2. And then what changes is it gets more dramatic. That's wave 3, and then you get 4, and then you get 5, and that completes your wave C. So this is looking like we're in a wave 3, and it's about to get pretty ugly. Now again, I flip-flop a lot. If we come back here next week and the market's rallied higher, I'll adjust what I think is going on. Although I did already talk about the possibility it could attempt to rally a little bit higher, and it's still, this could still be a big corrective move, setting up for another impulsive move down. Remember what I said earlier, remember when I talked about Bear Stearns? That happened in March of 2008. It wasn't until September of 2008 that everything fell apart. So this stuff doesn't have to happen in the next few days or even the next few weeks. It could spread out over time, and that's why we'll look at the big picture, but we'll also narrow down to what's happening day to day as well. But again, attempted rally today, looking like it's failing, rolling over. Now it could be that this is just wave A. You come down for wave B, and then you have wave C, and then you decline. You chop around a little bit. Wouldn't surprise me if the market just started to move sideways or choppy right into here a little bit because of the oversold condition we're in. In fact, let's take a look at that here before I forget to go over it. So most of the last couple weeks, we've just breezed through the direction alerts because they haven't told us anything. They weren't flashing any sort of extreme. Well, first of all, remember what I said here on this long-term indicator, we were getting real close to getting above -5, and now we're starting to see it moved off of that far side right there. Now, I'm not suggesting this means we're going to go right to a bull market. It could mean we ease up a little bit and then get slammed back down if the market sells off again. But that doesn't move very often, and so it's been a while since it's moved. All during this decline right here, we were below -5, and we just barely got above it to where that needle started to move in that right side direction there. Momentum, again, we're in the extreme reversal risk, and we're in the left side of that extreme reversal risk. Now, could we get a market panic sell-off in the next few days, and that pushes all the way to the far left side? Yeah, that can happen. But again, from a probability standpoint, it's more likely that we're going to rally a little bit here or move sideways. Remember, it doesn't have to rally to alleviate an oversold condition. It could just move sideways for a period. There's a chance that could be the outcome. It's probably more likely to bounce or move sideways. So you don't really want to short heavily into that type of condition there. You basically miss the easy money on the short which was that first move down over the last couple of days or so. Here it gets riskier. Now, if we rally up a little bit and then get a bearish reversal candle, that could alleviate that oversold condition a little bit and give you another shorting opportunity. But we're in an area here where the risk, you're in a bullish reversal risk, although it doesn't necessarily mean that you're expecting a big bullish run to take place. It's possible. In fact, if we had gotten down to this level, if we had a big massive sell-off, had a sharp rally back up, and we were had this little bullish looking ABC pattern, and we were down here and it was in this extreme reversal risk, I'd be saying, boy, that looks like a trend reversal. It might not aggressively buying, but I'd start getting into some positions there because it would have signaled the potential this was the bottom, the way it looks with that impulsive down, impulsive up move, and then the correction that's getting into that extreme reversal risk. That would lead me to believe that it has a good chance for a bullish trend to begin, but not in this context, at least not yet, for me at least. So, but we could see a little bit of a bounce to alleviate that oversold condition. Breadth, same thing, although this is not as oversold as the momentum. Usually when we're really extremely oversold, we're kind of past the halfway point. We're on the left side of that bar, and we're not quite there yet. This could be another reason that we could sell off, and probably the biggest reason is with all this selling and with these indicators getting into that extreme reversal risk, our sentiment indicator is still at the far right side. There's just no fear. And people are talking about panic and panic selling in the markets. There's not panic selling going on right now. There's shorting and short covering going on, but there's not. Maybe in some of the banks there's been some panic selling. Okay, so I'll give you that. There's definitely been that going on. But as far as the overall market, no, there hasn't been major panic. There hasn't been panic selling. There's been selling. There's been some fearful selling because the VIX did spike up to 30. But I mean, I would have at least would have liked to have seen this thing get over to the left side of that extreme box on this drop, but it just didn't happen. And to see how far it is from getting there, it needs to get down below this red line right here. It's still a ways away from triggering that. So there's a disconnect there. and again, markets can they can remain disconnected for a long period of time, and this has been a long period of time that we've been talking about this. But this is why I never base a trade on this alone. If I was shorting the market for the last for the last 2 years, because the sentiment indicator was in that far extreme complacency range, there have been periods where I really got beat up with that because it's not an exact indicator, but it is something that's been bugging me, and probably is going to keep bugging me until I see it, until I see that some fear in the market. All right, another thing too, buy-sell ratios are hitting an extreme. Did they get a little bit wider? They did back in on those October lows, but we're definitely wider than we've been in a while. So yeah, that's pretty extreme. And this sentiment indicator is very close to its extreme oversold level. It could get a little bit more extreme, but from a probability standpoint, we're more likely to see a little bit of a sideways move or a bounce soon, or in this area here. There's a risk there now that we're going to have to calculate in our decisions. And then look at the indexes right here. The buy-sell ratios. Look how extreme they are. S&P 500, there's 340 stocks that have sells, only 11 with buy signals. That's getting extremely oversold. So now this is where it can get tricky though, because like I said, there are times where these panic sell-offs can happen in these oversold condition. Market's already oversold, and it gets extremely oversold. But we've only had, especially over the last, at least when I've been trading, as long as I've been trading, we've only had probably about four or five major market corrections, or major sell-offs that have gotten really extreme. They got even more extreme. And so I think this could be one of them, which is why, I'm still kind of leaning more towards getting that continued move lower. But I also don't want to get so focused on that I ignore the conditions. The software is designed to not take anything else into account but the data. Okay, and what the data is saying is that you're in an area right here where, again, the market is probably more likely to either rally or move sideways. And so you've at least got to factor that into your decisions. Like I said, the way I would look at it is it gets to be a little bit of a dangerous place to short if you're opening up new short positions. Now, that's a little bit different from option trading, although I do look at extremes in option trading as well. That I try not to, if I'm in an extreme oversold condition, I try not to get too loaded up on put option trades because it can snap back against you pretty quick. It's possible, but I also don't get into call option trades just because you're in an oversold condition. You get these periods where you have neutral periods in the market where you're kind of waiting for the next direction, or waiting for the next waiting for the reversal to take place. In this case, we'd want to see some strong buying, not just short covering, strong buying before we'd want to be jumping in an oversold condition like this. All right, let me jump back to our charts here. It'll be interesting to see how we close. We're off the lows a little bit right now. Right now, though, it's just flashing indecision a little bit more of an indecision move. And that's been the problem a lot with a lot of these moves, is a lot of indecision moves have happened lately, and that's something to pay attention to. The market is trying to figure this stuff out. All right, other charts. I talked about the Dow. breaking below this support area right here. I thought that was significant. It's an area to watch if we rally back up. Does this now become a ceiling for the stock? We did have an intraday high that was pretty close to this area where it backed off of, but within the next few days, you want to see if that acts as a ceiling. The Qs were showing a lot more strength today, but it's also faded. There's some resistance right in this area right through here. I'd like to see that can it break out above that. Can you have more than just a one-day rally? A lot of times, remember, in bear markets or downtrends or really volatile conditions, everything gets amplified, meaning you have big down days and you can have big up days, but big up days aren't necessarily bullish. Very often some of the biggest market rallies have happened in bear markets or in big sell-offs in the market. What really signals a strong bullish market condition is when you get steady rallies. You get these smaller rallies, but they're consecutive. You get 4 or 5 days in a row where you rally up. Dow rallies 100 points a day or 200 points a day or something like that. The Dow going up 700 points in one day is after the market has dropped 1,200 points in 3 days or something like that is not necessarily a bullish move. So you have to be kind of careful of that. You don't get sucked into some of those big rallies within a drop. Like I said, a lot of it's fueled by short covering, and the volume a lot of times you get these big moves, but it's on lighter volume. That's usually a big sign that it's a short covering rally as well. All right. Now, one index that you do want to pay attention to for the next little bit is going to be the Russell 2000. We take a look at it. We watch it a lot anyway, but the reason why the Russell 2000 has made a very dramatic drop is because the sector, one of the biggest sectors within the Russell 2000 is the regional banks, the financial stocks. Financial stocks and oil stocks make up a majority of the Russell 2000 stocks. There's a ton of these small banks, oil company offshoots. There's tons of these little companies out there, and so that's why you're seeing a much more dramatic drop in the Russell 2000. But if you look at this, we're not too far away from the October lows on the Russell, and that's something I'm watching carefully too. Remember, the Russell tends to be a leadership index. Does it get down to those October lows or drop below those October lows? If so, it's probably telling you that the rest of the indexes are going to follow and move down there as well. So that's something I'm keeping an eye on. Bonds. The bond market made a huge move on Friday and Monday. Pretty dramatic, and usually it doesn't make these type of dramatic moves, but there's a big flight to safety, a lot of money coming out of banks, not out of the market. It was coming out of banks and going into the safety of bonds. So that's where a lot of that dramatic move came from. It came out of stocks as well, but there was a big move into bonds. Now we're kind of in the sideways range in bonds, so it'll be interesting to see, do we break out above here? At this point, the way the bond market is acting, if it breaks out above there, it probably means the market's selling off, and money is continuing to go into the safety of bonds. But just we're in the sideways range now. These are going to be our key areas to look at. We're kind of in no man's land right now. we'll see what happens over the next few days. We move down towards the lower end right here. And that's possible as well because those bond yields, with the CPI report that came out today, and there's the big discussion: is the Fed going to keep hiking or not? By the way, this gets back to what I talked about a lot lately as well, which is remember the Fed has got to get everyone to stop spending. That's how you're going to get inflation under control, is to stop spending. And part of that is you got to be afraid to spend. Now, one way that you're afraid to spend is losing your job. That's the biggest way. You lose your job and you immediately stop spending money. You cancel that second vacation or maybe even your only vacation you had planned. You go in, you start to use coupons for your food and what have you. Go into major slowdown in your spending at that point. Could the bank crisis here slow spending? It could have an effect, particularly in larger businesses that are at risk a little bit with their exposure. It could cause them to take some defensive measures. It's not the biggest way to slow things spending down. Like I said, unemployment is, and we already got that unemployment report, which ran a little bit hot last week. And so, everyone wants the Fed just to stop and start cutting rates. But I've heard this all day long. The smart thing for the Fed to do is just to forget this credibility issue and just start cutting rates, save the banking system or what have you. Well, I'll tell you what's going to happen is it immediately everyone's going to pile into equities again, and inflation is going to take off again. There's got to be enough pain to cause people to be afraid to spend. And if they take their foot off the gas right now, I'm not saying they raise 75 basis points or even 50 basis points, but they can't signal to the market that they're going to start cutting, or inflation is going to kick right back in, and then you have to start all over again, pretty much. So it's like it's not going to get, it's going to be ugly for a while, and there's not an easy way out of this. There's going to be pain no matter which route we go. All I can say is just be prepared for that, and hopefully we can make up for the pain through profitable trades. And that's what I'm trying to do but this whole situation there's people keep thinking they've got an easy solution for it. And I'm just shocked that these people get on TV and they spout this stuff. It makes me wonder, either they never took an economics class, and if they didn't take an economics class, why are they managing a major fund? That blows me away. Or they do know, and they're just trying to get you to go do something that's in their interest and not yours. They're trying to get you to go buy their shares or buy their stock that they're trying to get out of, or something like that. Or they're just incompetent. It's one of those, and it's just it just blows my mind sometimes that people don't understand the effects of these decisions and then factoring in human nature on top of it. All right, gold took off with especially that jobs report that came out on Friday. Now, could it be that it's going to continue this uptrend? This definitely is an impulsive move. What I kind of want to look at is see how the next correction looks. Is it pull back and a little bit of an ABC or sideways consolidation? I might consider maybe jumping back in. I still think longer term gold has a lot of upside potential. But this drop was bigger than I was anticipating. I got stopped out of a few of those gold trades that I was in, and I had pretty wide stops on those. And so I'm not as anxious to jump right back into a gold trade. But it is acting impulsive to the upside over the last few days. we'll see how that looks on Thursday and into next week as well. Oil, we're right back down to the lower part of this range. Now, this is something I told you. Remember, this is the lower part of this range is where the federal government's supposed to be stepping in and buying to replenish the strategic petroleum reserve. But what I tell you a while back, I said, don't just assume that that's going to happen. Politically, it'll benefit the president if oil prices go down, and he may try to let oil drop a little bit. Just because they said they're going to buy in this area doesn't mean they will. It's like when a company comes out and says we're going to do buybacks, but they don't tell you how much and when. And then they quietly don't do the buybacks, but they don't announce it. They just don't do it. There's a difference between announcing and actually doing, and so we don't want to just blindly buy oil just because it's down at this lower end of the range right here, where the U.S. government had said they were going to start to start buying. I don't see that in the price action. Big down candle today, and with these recession fears, it's going to put a lot of pressure on oil as well to continue to move down. But it's still right at this key support level. We're still trying to hold on to it. Actually, we'll probably dip a little bit below it. I think it looks like it wants to go lower, so we'll see if it continues to trend lower from there. I'd lean a little bit more towards being a little bit more bearish on oil right now. The dollar had a sharp move down the last few trading days. So we have gone to a lower low. We had this impulsive up, impulsive down. So could this be a trend reversal? It doesn't necessarily have to be a trend reversal. It could just be that this is wave A, you get wave B, wave C, and then it starts trending back up again. But that's something to keep an eye on. It could be that, if it keeps looking impulsive downside, maybe it is back into a downtrend again. This was the correction for the move down, although this didn't look very corrective looking. Sorry, I'm starting to lose my voice a little bit. I caught a cold yesterday, and I think it's starting to affect my voice here. So hopefully I have it for the rest of the week. I may sound pretty bad over the next few days. And then the VIX. Now the VIX, let's take a look at the actual VIX indicator here. Yeah, see, so we got up to 30. Came right off of that. And then now we're back down below 25. So, we're almost as close to getting below 20 as we are to getting back up to 30. And that can happen in really volatile markets. You can see the VIX really start swinging back and forth. But I think this move, especially when you look at it back out and look at in context a little bit, this looked like a little bit of a bottoming process right here. You had the spike up. I could see it pull back a little bit and then push higher. The big question is, does it get up there around 40? And like I said, 40 is kind of a minimum. It should actually spike up above 40. But I'm just amazed that it's not trading above 30 right now with how fragile this balance is with the financial institutions right now. So that's something to keep an eye on, especially if it goes back down to being below 20 again. That would really not make a lot of sense. Chip stocks. Now, I was looking last week at the possibility this could be or a couple weeks ago, this could be a bullish ABC pattern. But look at this. It should have taken off from there. And the fact that it's drifted sideways from there is more bearish. Now, I wouldn't I went short the chip stocks or buy puts on them until they break that support. If it breaks back below that support, yesterday it held that breakout area. Let me erase some of these lines. It held it here, held it here, held it here. Here was resistance back here. Here was a support area right here. If it breaks that, look out. It's probably leading the way down at that point. It's trying to hold up right now. I mean, even if you just want to look at, there's a lower high. You could draw kind of a descending triangle formation here. Obviously, if it were to break out above that, that'd be more bullish. But if it breaks down below that, look out. There's a little bit of support in this area right here. Then the next support's down here. So pretty big elevator drop at that point. Now transports, this is looking like a bearish head and shoulders pattern. It broke the neckline. Looks like it's retesting the neckline right there. This should continue to move down as well. You know, you can go back. This thing also broke this uptrend line right here. And again, this tends to be leading the Dow. So we'll see if we start to see the Dow break below that the support level we were looking at before on the Dow. Bitcoin's been up though. This is what's been mind-boggling to me. And it could be that people feel like Bitcoin's safer for their money than the bank right now, the regional bank. I don't understand Bitcoin enough to know how safe it is. I know that I don't trust the crypto banks that convert it to dollars for you or whatever. We've already seen a few of those go under, but I don't know. It's showing some strength here, and it could be, you know, I talked about this possibly being the bottom in Bitcoin when it you know, definitely had the bottoming behavior, panic selling, and nobody wanted to own it. Now you have this bullish move up. It's consolidation through here and kind of a cup with handle formation. And maybe it's starting to take off there. Definitely, you got a bullish pattern there. I wouldn't allocate a ton of money towards anything right now, but it's something you could start to nibble in a little bit if you got some crypto charts that look kind of similar to that and are pretty stable. Then you could start to build some small positions that you could add to later on with confirmation. All right. I did want to point out real quick, and I know I'm running out of time, but there's this downtrend line we broke above right here. We're back below it. And remember when we broke above it, I was telling you that this pattern right here looked very similar to the S&P 500 back in the 2000 to 2003 drop, the internet bubble drop. And I still think that, and now I don't anticipate that it's going to play out the exact same way, but I want to just kind of revisit that, just to show you that you know, it kind of did the same thing. Started to break out, looked like it was breaking out, and then it had that panic sell-off that marked the bottom in 2003. Find it here. Got to go back a few more years here. So back here in 2002, we broke, we had held that trend line, and then we broke above it right here. Now it took a little while. It came back down to it here, and then here was the panic sell-off that that marked the bottom. And even then, it moved sideways for another year or so before it started to work its way back up. But I see a lot of, I don't expect it to play out the exact same way, but it's interesting how we had the same breakout of that downtrend line. We're moving back down below it, and it's could it be that we're setting up for that bigger move? But also back then, it took a few months before it had that big drop. So like I said, it could be that we bounce around a little bit sideways before dropping, or have just some back and forth, but it wouldn't shock me if it did that based on the kind of the oversold condition we're in. Just a real quick, I did have a stock out of the new buy section. I liked General Mills, 94 strength rank. And again, decent reward to risk from here. If you don't feel like buying anything, I'm not buying anything, so I'm not adding this to portfolio, but it is a pattern I like. And so if we don't drop and we do start rallying, this is one that could rally with it. But it had a big pullback right here. I like the impulsive move off the bottom. This looks corrective. It could be rolling and starting to move up the right side of the bowl, so to speak. What I would probably do with the conditions we're in is wait to see if it breaks out higher right here, and then you can put a stop right below here. Or if you were looking just longer term and worry about if the market does tank about getting stopped out, you could put a stop down below here. I don't know if it still has its buy signal though. That was based on yesterday, so let's look at the signals here. No, it went back to hold. But that's the kind of pattern I like, so I did want to point that one out. And then on in the computer and technology sector, I like this ACLS. Again, probably wouldn't be a bad idea to wait for a breakout. In the portfolio, all I'm holding right now, and I did have that hedge with SARK. They use it's an inverse ETF that'll go up when the market goes down. I had that on. I took that off yesterday just because we had that little bit of a bullish reversal action. I may put it back on, but I don't only have one position, so I may not even put it back on. I'm fine just to sit tight, but I still have HTML. It still looks okay. It has an updated A. Hasn't gotten near my stop point yet at all. Still looks like a pretty good overall pattern there, so I'm still in that one. And then I had a question here on someone shorted PayPal. I do like this is a little bit of a riskier short in PayPal just because of the oversold conditions, so keep that in mind. But I am more bearish in PayPal. It had this drop, had this attempted rally right here. I don't think that support's going to hold. It kind of traded back to it yesterday at the close. That is something I've kind of looked at is, are there other financial institutions that could be at risk? And I immediately thought of the fintech stocks. Upstart was one. In fact, I had a personal put option trade in Upstart. It's not up by very much, but I started to look at some of these Square. That's up a little bit today, but again, now this could be a bullish ABC pattern right here, and this was a little bit of an impulsive looking move up, probably at about a 618 retracement level right there. So maybe this may not be the best short or put option trade, unless things start rolling over again. But PayPal, I think, is one that is acting like it still may want to go under. The one risk though is that this could be kind of wave A, wave B, wave C of a bearish ABC pattern where it rallies up a little bit and then drops. It's not acting that way today that it's going to rally, but there's always that chance that your corrective move moves a little bit more sideways before it drops again. And then you said Coca-Cola. I think you said you were short these positions. I don't like it when a stock moves sideways for this long. Now, you could say it was moving down before, it's moving sideways, it should have another move down. It could also be basing for a move up. It's also a consumer staple stock, which, people are going to buy Coca-Cola whether banks are collapsing or the economy is slowing down or what have you. So I don't love that as much as a short position as I would on PayPal there. But and I don't like the fact it's just been moving sideways. We've had all this market volatility and it's been moving sideways for the last 3 or 4 weeks. It's not going anywhere. It can be frustrating when stocks get into that just long, extended sideways range there. So, all right, I got to wrap things up. If you have any additional questions, go ahead and send those to jerry@traderspro.com. I'll be happy to answer those for you. And we'll see you on Thursday for the stock-specific class. Bye, everyone.